Well, the shorthand is 2 consecutive quarters of negative GDP growth. However, we had that in 2022, and I wasn't in the recession camp and we just saw this week, the trade deficit for January exploded as companies and consumers bought stuff.
Yeah, they're front end loaded.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, what's doing with these markets? Are we heading into a recession? And are we in the midst of a nascent bear market? Let's find out. Jim Welsh is with us, macrotides.com. And if you're listening to this on the podcast, in the show notes, there's a link to his latest newsletter, which we will be going over. Jim, great to have you back. So what's the verdict? Is this the bear market you were talking about?
Well, we'll see. I think the danger and the risk is there. As I've been writing over the last number of weeks, one of the things that has provided a cautionary signal is the S&P has been making new highs, marginal new highs at that, but the advanced decline line has not confirmed. It made its high back in November 29th. And the reason why this is important, Kerry, is going back to like 1928, every single major bear market and declines of 10 to 15% have been preceded by a negative divergence between the S&P making a higher high and the AD line not making a new high. So to me, that was a warning sign that the market was vulnerable. And then it's just a question of, does a reason to sell materializes? Because Wall Street is kind of a long bias. Mutual funds, pension funds, financial advisors tell people, hey, buy and hold for the long term. So in order to get people to sell, they have to be given a pretty good reason. And I thought the tariff stuff would provide a reason. A lot of people thought that Trump was just, it's going to be like 2018, be a lot of bluster, but not really make an impact. And my belief has been is no, he and his team are serious about tariffs, and it is going to have economic repercussions that could get us to the point of a recession. We just obviously have to see it play out. How far do they go? How far do other countries respond with retaliatory tariffs? But the bottom line is the uncertainty alone is causing businesses and consumers to pull back a little bit, Kerry. And consumers are worried about inflation. The recent University of Michigan confidence survey showed inflation expectations over the last 4 months have jumped from 3.3 to 4.3. That's a big move, And so that's an anticipation of tariffs. When we start to see price levels go up because of tariffs, that's just going to, I think, reinforce that.
Hey, what's some tariffs among friends, though?
Well, the problem is that even friends aren't going to appreciate it. And I get what President Trump is trying to do in terms of create a more level playing field between our trading partners and the United States. The problem, and I've written about this extensively, historically, tariffs have not worked out well. The last time we had a big tariff war was started and initiated by the U.S. back in 1930. With the initiation of the, Smith-Hawley tariff laws. And historically, globalization has provided a plus for global GDP growth, which has in turn raised living standards.
Yeah.
For billions of people and lifted a lot of people out of poverty. So to me, I'm not in favor of tariffs. In 2018, since we have a recent example to go by, the Federal Reserve and other entities have done an analysis, and guess what? It didn't increase jobs, especially in manufacturing, which is one of the stated goals. And inflation did go up. Granted, it was on a very narrow basket of goods, based on the tariffs from 2018. But the two stated goals weren't achieved. So doing this in a much more broad way, I don't see that it's going to generate the results that President Trump is hoping for. But, this is his belief system, and he's going to run with it.
So, but, when we look, the government needs more revenue, right?
Yep.
And in theory, like I remember when we had the so-called voluntary auto import restrictions from Japan.
Back in the 1980s.
Do you remember what the car companies? Remember what the car companies did? All they did, they didn't increase their production. They just raised their prices and increased their margins.
Prices, yeah.
So isn't it going to be the same thing back to the future here?
Well, again, it's a little bit more complicated relative to 1980 because about, I think, at least a quarter of all cars sold in the U.S. are manufactured primarily in Mexico and some in Canada. And what happens, Kerry, is, in a sense, the parts go back and forth across the border more than once as this production process is unfolded. So it's a little bit more complicated than back in the 1980s. But President Trump thinks, I'd say two things, and Scott Bessent, his Treasury Secretary, has kind of emphasized, from their point of view, extending the 2017 tax cuts is critically important to generate more growth. What you don't want is effectively a tax increase of between 4 and 4.5 trillion that would happen over the following 10 years. But to your point, tariffs provide revenue. And I think what they're hoping to achieve is by increasing tariffs on just about everything that comes in this country, it will generate close to the $4 to $4.5 trillion tax cut. So effectively, that's what they're going to pay for it. But the reality is, most companies, I think, are going to be more inclined this time around than in 2018 to pass along a greater proportion of the increase in their costs. In 2018, as remember, we had years, 6-7 years of very low inflation. Companies were competing for market share. So the idea of raising prices was like, oh, we don't want to do that. But after the inflation experience we had and companies having success in raising prices, I just think more of them are going to be tempted to say, all right, we'll absorb 20%, but we're going to pass along 80%. So there is going to be a jump in inflation from the tariffs. And that, I think, is a negative for the economy because we're so bifurcated. The top 10% of wage earners now making more than $250,000, Kerry, provide about 50% of all spending. The other 80% have not been increasing their spending at the same level. So they're under the gun. And I think higher prices, for whatever reason, is going to make their lives more difficult, and they're likely to pull back.
Yeah. Think so, huh? Well, I guess. Well,
and the real risk is, what's keeping the economy going, I think between September 23 and September 24, that top 10% of wage earners increased their spending by 12%. The bottom 80% in that 12-month window, their spending actually declined. So, what's fueling the spending of the top is asset values have gone up a lot. So if you have a stock portfolio over the last 5 years, you're in good shape. If you own a home, that's gone up 40, 50%. But if you're renting and you don't have a stock portfolio, you're much more paycheck to paycheck. And I think that explains it. But the risk is that if we see a significant decline in the stock market, some of those top 10% vendors will also pull back. So that's, I think, the risk for the second half of this year in terms of the economy potentially going into recession is that you get this initial slowdown as a reaction to the tariff war, or whatever it turns out to be. And then if the markets react negatively, you see a cutback in spending by those who have been spending most.
I gotcha. So effectively, though, you could make the argument that a tariff is simply a consumption tax, right?
Yeah. Someone's paying for it. I mean, it just comes down to, all right, will the originating exporting country pay for some of it? Okay.
Mm-hmm. And
not a lot, but they'll pay for some. The company that imported the goods, they pay for some. But 25% is a big number. So,
yeah.
All right, it's a consumption tax.
Right. So,
going under another name.
yeah. Well, all right. So let's say this happens now. So, is it necessarily negative?
Well, the stock market at least, is priced for economic growth. I mean, up until just the last few weeks, people were on board with this is going to be good for the economy. The economy's growing 2.5%, 3%. Might be a little speed bump from tariffs, but no big deal. So the fact that all of a sudden we're seeing economic data come in before the tariffs already showing signs of slowing, that's kind of challenged that sanguine outlook. And I think, in terms of the stock market, it's selling at a very high level in terms of P.
All right. But Jim, look.
But other measures of valuation. Just so,
Well, how do you define a recession? What's your definition?
Well, the shorthand is 2 consecutive quarters of negative GDP growth. However, we had that in 2022, and I wasn't in the recession camp and we just saw this week, the trade deficit for January exploded as companies and consumers bought stuff.
Yeah, they're front end loaded.
Exactly. And so, in the short run, what happens, the way they calculate GDP is gross domestic production. So everything that we import, they actually subtract that from GDP. So the Atlanta Fed has their GDP now thing, and it was like 2.5%. And then after Friday, when the trade deficit was reported, it went from 2.5 to a minus 1.5%, all because of trade. Now, the point I made back in 2022 and would make today is that represents demand. In other words, the economy isn't weakening because people are pulling back on spending. It's just the opposite. They're increasing their spending, and it's causing imports to spike. Now, what that means is in coming months, I think you'll see the trade deficit come down fairly significantly because you had this burst of buying pulling demand forward. And so we'll see GDP rebound as that takes place. Okay. The other thing is that inventories are going to increase, which adds to GDP. So you've got a lot of noise going on, and that's what happened in 2022. Kerry, is in the first quarter, trade brought the GDP to a negative. In the second quarter of 2022, Walmart, Target slashed inventories enough to cause the second quarter GDP in 2022 to be negative. So one has to kind of look beyond the headlines when GDP movements are the result of big swings in trade and or inventories. As long as consumer spending, which it was holding up in 2022, holds in there, then, we'll be okay for a little while. But I am, pretty cautious that I think if President Trump follows through on what his stated plans are, economic growth is going to slow more than most people are expecting.
All right. So, but look, you agree that the actual underlying inflation rate has been understated?
Yeah.
All right. So if we actually were to apply the proper GDP deflator, and we've been in a recession for 4 years, so what's the difference here?
Yeah. Well, the difference is, you're talking about a significantly higher, amplifying inflation by at least 2.5% a year, since that's what GDP has been kind of doing and growing at 2.5%. I'm not willing to go that far, but your main point is the economy has been struggling and weaker than what the stated GDP numbers are. I would agree with that. And again, it's because of two things. The government ran a deficit of 6.4% last year of GDP. Okay, we grew 2.5%, whoopee. But a lot of it was because of government spending. One of the things that Besant has said, their goal is to cut the deficit from $2 trillion to $1 trillion.
Yeah.
And the point I made is, hey, that's a worthy goal. Hopefully they will accomplish it. But when you cut spending in the economy by 3% or more, guess what's going to happen to growth? It's going to slow. So these are all the things that I think will take time to play out. But the combination of cutting government spending and consumers pulling back because of higher prices, I think we're headed toward a soft spot in the economy. Does it fulfill the official definition of a recession? We'll see. But I don't think the equity market has been priced for a significant slowdown in the economy, and potentially later this year, people beginning to worry about, oh my goodness, maybe we're going into a recession. Historically, the average bear market during a recession takes the S&P down 36%.
Mm-hmm. Okay. Well, so you're
Why?
You're up on the lecture.
All of a sudden, I have a really good reason to sell. Well, hey, you got to be realistic. One of the things that I'll touch on, because the Republicans passed a budget through the House last week, and immediately the Democrats said, "Oh my God, they're slashing and burning Medicaid spending. They're cutting $880 billion. It's going to be a catastrophe for everybody." All right. Mm-hmm. And when you and I talk, you say, well, I spent a couple $1,000 on meat last year. I think I'm going to cut back. We would say, okay, that means I'll spend $1,900 or $1,800 this year. That's not how it works in Washington. They develop a baseline of spending for the next 7 years. And so if they project Medicaid spending to rise by, let's say, 5% a year, and all of a sudden the Republicans say, well, no, let's only allow it to rise by 2%. So spending on Medicaid in the next decade will increase by $1.5 trillion. But the Democrats are calling that, a disastrous cut because the baseline had it going up by $2.3 trillion. Yeah. So in other words, spending is going up by $1.5 trillion, and yet the Democrats are calling that a cut of $800 billion. Mm-hmm. Only in Washington can a spending increase be termed a cut. So
back to their same old tricks.
Yeah. Tax cuts, the other thing. Oh my God, it's all they just want to give the billionaires and the rich a tax cut and the hell with everybody else. Well, here's the reality, and most people don't know this. In last year, the bottom 50% of wage earners paid 3% of the total income taxes collected. So that means the top 50% of wage earners pay 97%, with the bulk of that going in the top 25. How can you give a tax cut to people who haven't paid that aren't paying taxes?
You know what that's called? A negative tax cut, Jim. And
that's called a giveaway. That's called a giveaway.
But in all seriousness, they are raising taxes on the rich. If you own a sports franchise, you're not going to be able to depreciate your quarterback's arm or your pitcher's arm or your kicker's foot, and carried interest for hedgies. Yeah. That's going to end, and a couple of other things. So, it really doesn't amount to a row of pins in the scheme of things, but at least it's like, hey, the rich are paying their quote unquote fair share. But what about Trump's desire just to get rid of the IRS? If we had a consumption tax of, say, 15 or 20% national, would that be enough to make up for it?
I don't know. But again, that would be the argument against it, Kerry, is that at 50%, if you had a 15% tax on someone who's making $50,000 or $60,000, that's a larger burden than, a 15% tax on somebody making $1 million.
Yeah.
And they're spending $1 million. Okay. And I would quite honestly agree with that. Our tax system as it is today is really fairly aggressive. You just have, people are just not knowledgeable to know that in fact it is progressive and
it's counter,
it pays 3% of income taxes.
And it really doesn't achieve its purpose.
It's like mushroom management. Mushroom management. Keep them in the dark.
Them in the dark.
Feed them a lot of fertilizer, and then can them.
A lot of excrement. The more excrement they get, the better it is, right?
I decided to go the higher road with fertilizer.
All right. So,
but we're at the same place, right? So my only point is that you have, the Democrats will do everything they possibly can to undermine what President Trump is doing. And some of the things, that the thing I point out in the March letter, Macro Times letter, is the GAO last April, Kerry, came out and said, you know what, somewhere between 230 and $520 billion of fraud and waste exists every single year in government spending. So, all right, so here you have Doge and Elon Musk trying to do some due diligence and identify some of that fraud and waste, and the Democrats are going out of their minds.
Yeah, because they're the recipients, because they're the direct recipients of much of that fraud, which we've seen from U.S. aid, and sprinkled all throughout the government, all over the place.
Right. So my point is, unfortunately, Musk pulling out a chainsaw, not probably the right look. Just take it serious, be serious.
I like it.
I laugh too. At the same time, you're giving political fodder to the opposition to be able to say, look at this guy. He's trying to take your Medicare, your Social Security, your Medicaid.
No one's buying that stuff, Jim. They don't.
Oh, the Democrats are. Oh,
they're a minority, and they've spewed so many lies here, and not that the Republicans are so innocent either, but they've controlled the government for 12 out of the last 16 years.
Yep.
And all this fraud escalated. And one thing we learned from Doge is that you always knew it was happening, but it's way worse than you ever thought it could possibly be, right?
Right.
We see it. So they've lost their credibility. They lost their moral high ground, if they ever had such a thing before. And now the fun begins, because we just scratched the surface here. The fraud is rampant. And I don't know about you, but if I had to take a guess at how much money the government wastes every year, and how much is stolen and whatever that falls into the sinkhole, I think it's 35 to 50%. I think that's a reasonable guesstimate, and nothing I've seen so far from Doge has convinced me otherwise. You?
Yeah. No, I mean, I think the goal of ferreting out waste and fraud is absolutely necessary and required, and it's sacrilegious that it hasn't really happened in very, very long time.
Waiting for.
The only thing I will say is, though, you say, okay, they lost credibility. Not with the Democrats, okay? In other words, the Democrats, get most of their information from the New York Times. The New York Times is going to say stuff that may not be attached to reality, but it's the spoon feeding of the faithful that they're going to believe.
Yeah.
Here's a poll. Gallup came out with a poll that was taken on February 19th, asking people, what kind of job you think President Trump is doing so far? The Republicans were 93% approval. The Democrats were 4%. So what I wrote about in the March Macro Times, what this shows me is there's a whole bunch of people in the Republican Party who think, Trump is the second coming of the Messiah and can do no wrong. And in the Democrats, he's the devil incarnate who can only do evil.
Yeah, but they have no power now, the Democrats. They've been co-opted out. Right?
What's the majority in the House for the Republicans?
Yeah, well, but then we get into voter fraud and other things.
4 seats. What do you think is going to happen in November of 26?
I think
they're going to lose those. They're going to lose that majority.
I doubt it. I honestly doubt it.
Again, my only point here is that you have both camps. There's people in the Republican Party and the Democratic Party that are incapable of critical thinking.
Yeah.
So that's the problem. I think that.
But come on, the fraud. It's not just the budget where the fraud's rampant. We know it's rampant in the electoral process here, too.
Again, that has to be proven beyond the shadow of a doubt.
There's no question.
Or you can get hardcore people who are Dems to believe any of that. They're just, again, they're going to believe that, they're just making all this stuff up and they're hurting a lot of people around the world.
Yeah. Well,
I have relatives that are really liberal, and that's what they tell me.
yeah, they're not critical thinkers. I agree with
All
you
there
there,
is happening
but
because that's their mindset. Yeah.
but you know, uh, I think it's interesting that there's been no discussion at all of voter fraud and cracking down on it, other than there's a couple of scattered cases, one in Florida, which actually details how the fraud takes place by this voter registration cloning. So it's too early to make predictions for 26, but you know, recession, we've already been there and done it, so it'll get a little worse. But people don't even understand it. They don't understand, Jim, that their purchasing power in the dollar has lost 98% since 2013, maybe 99. I mean, since 1913, rather, in the 100
Years of the Fed.
12 years of the Fed. The fact that they've carried it on as long as they have is pretty remarkable. Okay, so the market, what do you think the decline's going to be here?
I think we're going to get a bounce in the short term. The S&P this morning got down near their 200-day average. That for some people is like, okay, this is a place to buy.
Yeah,
I think
covering,
that,
right?
And then some short covering kicks in. But my take is whatever bounce that happens, I think is going to be followed by another leg down, because I think Trump is serious about the tariffs that they're going to enact on April 2nd. So to me, if the market got stretched, the S&P dropped like 250 points from yesterday morning to this morning. That's a heck of a move in a very short period of time. So you get a snapback rally. I think there's another leg down that's coming. And if things blow up into a full-blown trade war, 20%, I think that's possible. So we're talking about a move down to 4,900, 5,100 potentially on the S&P. So I've been cautioning my subscribers that, hey, things are weakening. We're going to have a reason to sell. It's going to get a little ugly. In terms of gold, I think gold is near an important high.
Yeah, I was going to ask you about that. So we're getting close to 3,000. Every time it gets close, it gets slammed, right?
Yeah, I mean, just from the price pattern, from the low back in September of 2022, gold bottom at, I think, 1,612. To me, price pattern-wise, it looks like we're completing the fifth leg of that rally, and we're in the fifth leg, and there's one more pop to take gold above 29.54. But I think that sets the table for a pullback that could take it under 2,600. The first target would be the most recent low at 25.41. So I think this is a place to be lighting up on gold.
All right. And so what do you invest in? Bitcoin?
I think, when Bitcoin was trading at 103,000, I basically said I think it's going to 73,000. Haven't gotten there yet, but I still think that's not an unreasonable target. So I think Bitcoin, like the S&P, we're working our way down to a lower price. And so you get a hit, you get a rebound.
Mm-hmm. Okay.
You get hit, you get a rebound. I think it's going lower.
Oil?
The Saudi Arabia and the OPEC said they're going to increase production a very, very small amount. The main thing is if the economy slows, Kerry, I think that means less demand for oil. My take is that oil has a shot for 60, 62. I think it's trading around 67.
Oh, geez. Is anything going to go up besides inflation? This reminds me of Will Rogers, invest in inflation. It's the only thing going up.
Well, again, I think the thing is if we have a full-blown recession, what's going to happen is you're going to get this pop in inflation from the tariffs. But that's a one-time adjustment. It's not like, hey, we're going to do all this again next year or the year after. It's a one-time adjustment. So I think what happens is you get a pop of inflation, and then as the economy slows, that inflation starts to melt away. and because demand will drop as people pull back. So, again, I think near term that's problematic. I think the biggest risk is if the CPI gets up near 4%, which it very well might as we get towards the summertime. The Fed has to make a decision. In 2018, they decided to look through the tariffs. They weren't, the tariff increases were relatively small compared to what we're talking about today. And the one-time nature of them, they thought, okay, it's going to pass through. Plus, inflation expectations were really well controlled and had been for years. So the Fed might have a real tough decision. But I don't see them raising rates, Kerry. It just comes down to delaying any cuts for a while longer.
Okay. So rate cuts, they'll put it off as long as they can, or what do you think?
Yeah. Again, you're going to need to see the unemployment rate really tick up. That's what will get them and prompt them to make a decision to lower rates. Plus, at that point in time, they will have a much better handle, like all the rest of us. How far are the tariffs going? What is the size? How long are they going to remain in place and so forth? The Fed then will be able to do some modeling to guesstimate, all right, how big of a pop in inflation are we going to get? How long will that potentially last? So, they're flying in the dark like everyone else. We have known unknowns. The problem is they're still unknown. So I think the Fed bias is to lower rates, but they're going to need kind of evidence, if you will, and justification to do so, especially if we see inflation ticking up. The only thing that can justify it to me would be the unemployment rate ticking up to 4.3, 4.4, 4.5. Then they're going to act.
Interesting. All right. Well, so, but then we have the inflation, right? So.
Well, again, economic slowing and recessions historically always bring inflation down.
Yeah, that's true.
That's the pain. That's the trade-off. That's painful. Okay, we got inflation down, but the unemployment rate went from 4 to 5, or whatever the numbers are. And the Fed has been trying to avoid that over the last 3 years. And fortunately, energy prices came down a lot. If we see oil prices drop down towards 60 and stay there, that'll help in terms of headline inflation. President Trump has said he wants oil companies to increase production and so that the daily production level goes from 13 to 16 million barrels a day. And the problem is that oil companies have changed the way they do business in the last 3 to 5 years. It used to be people with prices were high. Okay, let's drill like crazy. Well, shareholders got mad and said, no. When prices are up, you can keep drilling the same amount, but pay us more in terms of shareholders by buying back stock and dividends. So will oil companies respond to President Trump asking, hey, I want you to increase, drilling? And so, yes, they will. I just don't think they're going to be aggressive to the extent of causing production to go from 13 to 16 million barrels.
Let's not forget, though, that the fracking revolution did not come from the majors. All right?
No.
The majors aren't going to be the ones that find the oil. They don't. It's the wildcatters and those big, small ones to small, medium ones. Those are the ones. And we have a new technology that hasn't been written about at all because everyone knows about fracking. And we assume that the fracking revolution was over. But then they've got this new thing called refracking, right? And that's bringing out even more oil than the initial frack did. So what the problem has been is that the capital was like choked off from these markets by ESG and the
Biden administration
and whatever. The new Green Deal, that's not going to be the case now. And that's what I find kind of interesting is
I had not heard about refracking. Thank you for mentioning that. I'm going to look that up.
Look it up.
One thing I will tell you is over the last 3 to 5 years, a lot of the major companies have bought some of the wildcatters down in the Permian Basin, so their impact is less than what it was 4 or 5 years ago. But there's still some of them are going to pursue an aggressive strategy. But obviously, if a new technology makes a difference in terms of producing more oil out of existing wells, that's a big deal.
Yeah, the refracking is a big deal. They actually go back into the well. That's, because the whole thing was the production cycle was, real high, and then it dips off, and then eventually it's down to like a stripper well doing, 10 barrels a day. And that's what they anticipated for all of North Dakota. But refracking, and I will refracking, it's kind of the same as fracking, except they go back and they frack it again, and it turns out it winds up here. It can double or triple the output of an existing well, cost up to 40% less than drilling a new well.
Yeah,
doesn't require additional state permits, less disruptive to the environment because the environment's already been disrupted. You're just going back to the old well.
Yeah.
So
now it'll be interesting to see the longevity of those wells. They get a boost of 30 to 40%. Is it maintained for 3 years, or is it more like 18 months? That'll be another factor.
Okay, well, here we have an answer for you there, Jim.
Oh, I came to the right place.
You got it, then. Refracking can significantly extend its lifespan, potentially adding several years of production to a well that would otherwise be nearing the end of its productive life, allowing for a longer overall extraction period compared to single fracking. However, the exact longevity depends on factors like initial well quality, reservoir, and the techniques used. So
some wells may last 3 years, every 18 months. It depends.
My guess is they will come up with something else after refracking, because there's still
historically been the history.
Yeah. So, but it is interesting to think about it. All right. So macrotides.com. Sign up for Jim's service there. Make sure you click the link in the show notes if you're doing the podcast or the video. You can view all of Jim's forecasts in one place. Appreciate you coming on, Jim. Hey, if you've got a question, shoot us an email, kl@kerrylutz.com. We'll get you an answer. And the link to Jim's site in the show notes of this interview on financialsurvivalnetwork.com. Jim, appreciate you stopping by. We'll talk again soon.
Kerry, and if you want, you can tell your viewers and listeners that if they send me an email, jimwelshmacro@gmail.com, I'll send them the March macro tides that just went out on Monday.
Even better. Okay.
Even better.
All right.
So great joining you.
All right. Take care. We'll talk to you soon.
Stay well.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.